Did you know that over 50% of Americans have never owned a single stock? Surprising, isn't it? This statistic may leave us scratching our heads wondering why so many are estranged from the bustling world of the stock market. This video is here to bridge that gap, to demystify the stock market, and make it more accessible and comprehensible for the average person. So, buckle up folks, we're about to take a deep dive. Now, it's time to unravel the mystery of the stock market. Before we dive into the mechanics, you might be wondering, what exactly is a stock market? Well, in its simplest form, the stock market is a public marketplace where shares of publicly traded companies are bought and sold. Think of it as a bustling bazaar or a grand shopping mall, only instead of buying shoes or handbags, you're buying and selling pieces of companies. Now, these pieces of companies are what we call stocks, and each stock represents a tiny slice of ownership in a company. When you buy a stock, you're effectively becoming a part owner of that company. Fascinating, isn't it? But why do companies sell stocks? Well, it's a way for them to raise money. When a company needs funds to grow, instead of borrowing from a bank, it can sell stocks to the public. This process is called an initial public offering, or IPO for short. And what's in it for you, the investor? The potential to make a profit, of course. If the company you've invested in does well, the price of your stocks may go up. And if you sell your stocks at a higher price than what you paid for them, you make a profit. But remember, the stock market is not a guaranteed money-making machine. There's always a risk, as stock prices can go down as well. So, now that we know what a stock market is, how does it work? Stay tuned to find out. The stock market operates on a system of supply and demand. It's a marketplace where buyers and sellers come together, but instead of trading goods, they trade securities, stocks to be precise. So, let's break this down. Companies issue stocks to raise capital. This could be for a variety of reasons, to invest in new projects, to pay off debt, or even to maintain their operations. When a company decides to issue stocks, it's essentially offering a piece of its ownership to the public. This is often done through a process known as an initial public offering, or IPO. When you, as an investor, buy these stocks, you're essentially buying a piece of that company. You become a part owner. You've probably heard the term shareholder before, right? Well, that's you now. You hold a share of the company. Now here's where it gets interesting. If the company you've invested in does well, the price of your stocks increases. This could be due to a variety of factors: increased profits, a positive change in the company's industry, or even just general economic growth. On the flip side, if the company does poorly, the price of your stocks decreases. This could be due to disappointing earnings, a negative change in the company's industry, or even a downturn in the economy. So, how do you make money in the stock market? Well, the goal is to sell your stocks for more than you paid for them. Buy low, sell high, as the saying goes. But remember, the stock market is volatile and unpredictable, so there's always a risk involved. As you delve deeper into the world of stocks and trading, you'll come across terms like bull market, bear market, dividends, and capital gains. Don't worry, we'll get to those in due time. For now, just remember this: stocks represent ownership in a company, and the price of these stocks fluctuates based on how well the company is doing. But how do you know when to buy and sell stocks? That's where the stock exchange comes in. The stock exchange is the heart of the stock market. It's the bustling arena where stocks, or shares of ownership in a company, are bought and sold. Think of it as a grand marketplace, but instead of fruits, vegetables, or trinkets, the goods being traded are stocks. Now you might be wondering, how does the stock exchange work? It's simple. The stock exchange operates as a platform that brings together buyers and sellers. Just like any marketplace, the stock exchange facilitates transactions between these two parties. It's the go-to place for companies who want to sell their shares to the public, and for investors who want to buy those shares. But how are stock prices determined on the stock exchange? This is where things get a little more interesting. The prices of stocks are primarily determined by supply and demand. If a company's stock is in high demand, meaning there are many buyers but not enough shares available, the price of the stock will rise. On the other hand, if there are more shares available than buyers, the price will drop. It's the classic law of supply and demand at play. Investors' perceptions of a company's potential for success or failure also influence this. If a company is expected to do well, demand for its stock rises, pushing the price up. Conversely, if a company is expected to struggle, demand falls along with the price. Keep in mind that the stock market isn't just about buying low and selling high. It's also about investing in the future of companies and, by extension, the future of innovation, employment, and the economy. When you buy a stock, You're buying a piece of a company's future and betting on its success. Now that you understand how the stock market works, you're well on your way to becoming a savvy investor. You're not just playing a game of numbers, but participating in the growth and development of companies, industries, and the world economy. So here's to your investing journey. May it be exciting, rewarding, and most of all, prosperous. Let's quickly recap what we've learned today. We've unveiled the mystifying curtain of the stock market and discovered it to be a public marketplace, a bustling hub where shares of public companies are bought and sold. It's a place where dreams can be made and fortunes can be lost. We also learned that the stock market operates on a system of supply and demand. When more people want to buy a stock than sell it, the price goes up. Conversely, if more people wish to sell a stock than buy it, the price falls. It's the economic dance of supply and demand in its purest form. Furthermore, we've uncovered the role of the stock exchange as the grand facilitator. It doesn't just enable these transactions, but it also plays a crucial part in determining stock prices. Remember, the stock market isn't as complicated as it seems. With a bit of knowledge and practice, anyone can become a successful investor. Check out the links in the description to start investing and subscribe to get more content about investment and trading.